Thank you so much. I'd like to say that I love Nairobi. So whenever this is my fourth time to Nairobi, and it's always a pleasure to be here, and I'm looking forward always to come again. So we have a session about a couple of very vague terminologies, actually even for me. So we will talk about things that I don't really understand very well, but the gentleman will explain to me. So we will talk about blockchain, cryptocurrencies, stable coins, and central bank digital currency. Those are some of the new, I have to say, terminologies, but as well products when it comes to the financial system. And the focus of us will be on the impact of those products on the remittances. I have a very distinguished panel with me. Barry Cooper. Barry is the technical director of GFRID. I have as well Richard McKay. Richard is a principal manager, trade and exchange department in the Central Bank of Nigeria. I have Alan Martin, head of consulting and CBDC lead in Tails. And finally, I have Chris Ostrovsky, Chief Executive Officer and founder of Soda Public Digital Money. And myself, my name is Ahmed Faragallah. I work for the World Bank, and I focus on payment systems in general, and specifically the maybe in some of the innovative products like CBDC and others. So maybe let's maybe check first the blockchain. The first, part of what we need to talk about. Blockchain is a database. So blockchain is nothing more than a storage of data. So if you are familiar with databases, blockchain is another form of a database. It's a place or a number of files where you store data. Why they call it blockchain? Because every few records or every amount of information that you add to the file, it just creates a block, and this block is somehow encrypted and somehow locked. So you cannot change it in the future. So doing so, by having a blockchain, people found a way to ensure that whatever they will put in the database will not be changed in the future. So whenever you store the data, it's very hard to alter it or change it. This is the very simplest way of the definition of a blockchain. From blockchain came the first maybe a product of the financial. By the way, in the blockchain, you can store anything. You can store informational data, you can store medical data, you can store anything, but you can store as well financial data. The first product that came maybe very famously from the blockchain was the Bitcoin. Bitcoin is simply a product, a financial product. It holds some sort of ownership of value of this value itself is no one created, no central bank created this value. So it's created by machines. But in a simple way, the Bitcoin is a way, if I hold a wallet with a Bitcoin, then I have some value, I have some funds, and I can transfer it to others. This is maybe the first product that came out of the blockchain, financial product, and this is what we call a digital, our cryptocurrency. So the first part here is the cryptocurrency. Let me maybe go to first start with Barry. Bitcoins used by very few people or some maybe organizations in sending remittances from one country to the other. Do you think that this is, I have to say, a way that would bring value to the end users, bring value to the whole community, doesn't imply risk or anything like this. So maybe you can give us a little bit of some information about how Bitcoin could be used in sending remittances, and what are the value and the risks associated with Bitcoins?
Sure. So technically, yes, it's possible, and we've worked with remittance service providers that actually use it, but it just depends on how you use it and what the regulatory framework is that it operates within, and what the risks are. So that's very important. Particularly some of the remittance service providers that we use, they use an exchange, and then they intermittently use, I wouldn't say Bitcoin, but other value or virtual assets. The reason why we don't really call them currencies is because they don't have any kind of, as you said, there's no liability. Who's liable for the value? It's just an asset. It's an asset like any other commodity. So it's a virtual asset. So you use the exchanges, and it's at the point of exchange where a lot of the regulation really needs to happen, where the framework needs to happen. And currently, it's actually even difficult to register those remittance service providers, because they neither trade in foreign exchange, or they don't trade in currency. It's a big problem. And so what we have seen is that some of them just operate lawfully, but in a vacuum. And so those are some of the issues. The other issue is in terms of having the proper regulated exchanges on each side of the transaction, and then the ongoing regulatory frameworks that really look at the risks. Who's going to pay out these risks? What happens if the intermittent transfer has a big adjustment in terms of market value of those? So there's a lot of volatility in these things. And so who's on the hook for this? Who's liable? Ultimately, the consumer is going to pay for that. But what are the implications? So what we have noticed is that these value-added service providers can go get issues. The remittance service providers themselves can get into issues because of, they really don't know how to register them, because there's no liability. What are they trading in? It's not foreign exchange. So there's a lot of gray areas around it. But does it work efficiently? Yes, it works very efficiently. And from the remittance service providers, we've seen it's added an immense value, but that value does not really include a discount for the risk that they face.
Thank you, Chris. Maybe the point that Chris mentioned regarding the volatility of the price of Bitcoins or cryptocurrencies led some people to move actually two major aspects with the Bitcoins. The first one is the governance. So instead of being publicly owned, so in reality it's not owned by any specific person, they moved to a regime where there is a governance, there is an entity or institution in charge of the issued crypto asset. The other part as well is that instead of keeping the value of the Bitcoin volatile up to the market, it could be 60,000 US dollars or $8 US, and it goes up and down. Now it's in the range of 20s if you are investing. They added some sort of what they called a stabilization mechanism behind the Bitcoin. And from here came a new type of crypto assets, which is called stable coins. Stable coins is another type of crypto assets, but it has two major, from my perspective, two major issues. One issue, or what major I have to say differences from the Bitcoin. The first difference is that it's issued by an organization, or an organization is in charge of it. There is a governance behind it. The second part is that it has a sort of a stabilization mechanism, so the price would not volatile up and down. Let's maybe go to Chris. From your perspective, what would be the value of stable coins in remittances business, and again, what could be the risks behind them?
Thank you very much, Ahmed. And before I just answer that question on stablecoins, I just wanted to say that before we started, Pedro actually said that, you know, there'll be a big difference in the level of knowledge in this room. Some people will know a great deal about Bitcoin and blockchain, and other people will know very little. But as I look around, I can see very many wise people, and you have to guess how I know you're all so wise. It's because you chose to come to this session and not the other session. And because of that, you will get a free drink from me at the reception this evening. They're free anyway, of course. But I think the first drink should probably go to Ahmed, who actually grasped the nettle and tried to describe and explain Bitcoin and blockchain, which is a notoriously difficult thing to explain and describe. I've tried to explain it so many times, and that was one of the best explanations, so thank you for endeavoring to do that. Stablecoins do play an important role, and if we look at why the blockchain and why central bank digital currencies, CBDCs, are important in the context of remittances and in the minds of central banks, there are really kind of two reasons for that. First of all, if we turn the clock back to 2019, that was the year that everything changed. In 2019, three things happened. China publicly announced that they were trialing their own CBDC, the yuan. They publicly announced that. There'd been rumors, but they announced it publicly. The second thing was that Bitcoin just became bigger, particularly in many emerging market countries. Bitcoin became a channel for remittances. It even became a store of value, and it was used for some transactions. But the third thing by far, and by far the biggest thing, and you can divide history into before and after this moment, was when Mark Zuckerberg and David Marcus said, we're launching our own Facebook dollar. We're launching Libra. Since then, everything has changed. I've been working with central banks for many years, and I was working with them at that time. And the thing that really terrified them wasn't that it was such a crazy idea, wasn't that it was Facebook that was doing it, it was how feasible it was. It is perfectly feasible for Facebook to create their own dollar, and everyone in this room could use the Facebook dollar for peer-to-peer transactions, cross-border transactions, remittances. They were going to build their own blockchain to do it. It was perfectly feasible. And that made the central banks run to the hills. And so since then, we have seen central banks looking far more closely at blockchain-based currencies, stable coins, cryptocurrencies, and also central bank digital currencies. And I think, what does the blockchain offer, which is so different? I think there are three things. Cost, it's a fraction of a cent to send money. Speed, there's atomic settlement, so you can settle transactions immediately, and traceability. And if you think of all the things we've been discussing today, we were just discussing data on the previous panel. The traceability will give you complete access to data if you wanted to do that. Speed, you can you don't have to wait for your money, and the cost is far lower than even the Sustainable Development Goals target. So this is the reason why it holds such appeal, such captivating appeal. But just because it can do those things doesn't mean that it will. You have to find a practical use case, a practical way of applying these advantages for remittances and for central bank money. And stablecoins is certainly one of the ways of doing that. I think when it comes to stablecoins, at the moment we have privately issued stablecoins. I still call stablecoins public money. When I use the term public money, I mean anything that's denominated in a pound, a rand, a shilling, a dollar, a euro, but it's privately issued. And many central banks are looking at both CBDCs, their own form of token money, and a form of stablecoin that could, say, be issued by a bank or a fintech or a remittance provider. And the stablecoin which is authorized can then play the role with some of the advantages in terms of speed, cost, and traceability that I was describing.
Thank you so much, Chris. So moving from the cryptocurrency to the stablecoin, the third maybe product that we will discuss here, and we will focus on it the rest of the session, is central bank digital currency. Central bank digital currency, again, coming to the definition, it's the simplest way is to compare it to the banknote and coins that you hold in your pocket. The only difference is that it is in a digital form. So the banknotes and coins are a liability on the central bank, and the wallet that would hold the CBDC, again, the value there would be a liability on the central bank. Just to this is a very economical issue, and I'm sure it is very confusing. Whenever you use your card or maybe wallet to buy or to pay to someone else, to pay to the merchant, for example, using your own card, the card reflects a balance in your commercial bank account. So from economic perspective, this is commercial bank money. This is not central bank money. Yes, it is somehow there is an agreement between the commercial bank and the central bank, and they are under supervision and everything. But this is not the money issued by the central bank. This is money issued by the commercial bank. Commercial banks make money. Commercial banks issue money. So on the central bank, if you will have a wallet with a CBDC, this would be a liability.
Search of digital currency from 2017. But in 2001, we deployed the first digital currency in Africa, called the e-Naira. Why did we? Because globally there has been a decline in the use of cash, and we know there has been an increase in private monies, and also there's been an explosion in digital payments. So the central bank went ahead to make sure it catches with reality, because that's the reality. There's no going back on digital payments. So the central bank deployed the digital currency. For a country like Nigeria, 81% of the population has access to a mobile phone. And if you have access to a mobile phone, not up to 40% of the population has bank accounts, but 81% has access to a mobile phone. So deploying the e-Naira will mean having more reach to whoever has a mobile phone. And we went ahead and opened up a sandbox so that, and we have already proposals, and it's almost going to be deployed for future phones as well. We have online, offline payments as well. So for questions that will be asked is, what if I don't have a smartphone, what do I do? So future phones have been there. We have a system called a USSD. So you can make payments using USSD. You can make payments offline mode. You can make payments on future phones. And that way, I said 81% of people have access to phones. And if they do, and then 81% of people now have access to their e-Naira wallets if we get the adoption right, it means more people are going to be brought into the financial service, and that will improve on the financial inclusion. Thank you.
Thanks a lot, Richard. Actually, the World Bank has a position here, and we always say that CBDC is not a panacea for financial inclusion, but it could support the other activities that the central bank is doing when it comes to financial inclusion. So it will not solve the problem by its own, but with other measures, it could help in enhancing the access to finance. Alan, maybe, and you provide a sort of consultancy to central banks on aspects related to CBDC. When a central bank comes to you and asks if CBDC would help me in enhancing the remittances to the country, how you answer such a question? Yeah.
Thank you, Ahmed, for the question. Actually, before I answer your question, I'd like to make a few comments on what was said before with regards to the other possibilities, you know, Bitcoin, a stable coin, and I think there are important criteria to consider when you choose these new technologies to implement remittances. And one of them is energy consumption. I don't think you should choose a solution that's going to consume an enormous quantity of energy. And so that rules out Bitcoin immediately. And so this is, I mean, I think it's part of the number one considerations. You're not going to adopt new technology that consumes as much power as a country like Iceland or even larger countries, as a matter of fact. And the other one is speed And that's going to start answering your question. Because if you choose this kind of technology for remittances, it may be interesting to consider what the recipient is going to do with the money it received. Is it going to cash out immediately, or is it going to transact with that money? And that leads to the CBDC question. And so if it's of interest that the recipient uses the money it has received to transact, in other words, not to cash out, but to pay somebody that will pay somebody else, and so on and so forth, then you get into transaction speed. It's got to be convenient. It shouldn't take too long. Okay? And that's also going to help you choose technology. Some implementations on blockchains are rather slow, so you have to consider that. Now, to come back to CBDCs, it's actually quite interesting to come back to the origin of remittances, really, because at the beginning, remittances were sending banknotes through the mail, send banknotes to somebody at home. And maybe they'll convert those banknotes, and so there'll be some foreign exchange stuff, but you send banknotes, before it became electronic. And so, in other words, those remittances were from public money to public money. You didn't go through commercial bank money. Today, when you use a remittance company, you go through commercial bank money. You've converted cash, which is central bank money, into commercial bank money, and at home, it was converted again to central bank money by cashing out. And so if cash is now digital, you can see that there will be, this is a major assumption because we are nowhere near CBDC deployments, by the way. But in a future where CBDCs are deployed, you could do remittances from CBDC to CBDC, and there's no need to go through a commercial bank money step. You just convert. Now, behind that assumption, there are a lot of things to do in terms of building this stuff and make it interoperate and probably standardize it to some extent. So there's a lot to do. But let's say that the promise of CBDCs in relation to remittances is that you could do something very simple. You just send CBDCs and they're converted to the local CBDC, or you convert them before and then you send them, So, and to continue on the question, and coming back to my point as to what do you do afterwards when you've received money as a recipient. Again, this is really a question mark for the audience, really, but is it of interest to cash out immediately, or is it of interest to continue using that digital cash for local transactions in the recipient's country? And so here you get into the considerations you were mentioning, for example, around offline payments, because that's what we do, by the way, at Thales. We're focusing on offline payment support for CBDCs. But it's interesting if you think it's of interest for recipients to be able to pay other people with the money they received, rather than cashing out, then you get into these notions of, can I use it everywhere and anywhere at any time? And online transactions don't really answer well. They don't necessarily work all the time, anywhere, at any point in time. And so that's why it's interesting also to consider this offline use case, whether it's CBDCs that are going to be used or stable coins of some kind, but it's of interest to consider offline payments if the recipient is going to be enabled to pay with the money received.
Thank you, Alan. Chris, let's assume that in order for two countries to have a CBDC arrangements between each other, we may have two scenarios. We might have a scenario where each central bank is issuing its own CBDC in its own currency, but they have an agreement between them, bilateral agreement between the two central banks, where they can exchange the value from one CBDC to the other. So, for example, a person in Kenya working in France In this case, he wants to send to his wife, who is based here in Kenya. In this case, he will have a digital euro wallet in France, and she will have a digital shilling wallet in Kenya. And there is an agreement between the Banque de France, or European Central Bank in this case, and the Central Bank of Kenya, and the transfer would happen directly to the central banks to the direct user. This is one scenario. But another scenario is if the European Central Bank allowed non-residents to have accounts or wallets in digital euro. So it would be possible, or it might be possible under this scenario, that the wife based here in Nairobi would have a digital wallet in digital euro. So considering those two scenarios, what are first the constraints of establishing those scenarios? What are maybe the pros and cons of both scenarios? If you can help me with this issue.
Yeah,
I'm thinking a lot of this.
Indeed, and it's important, I think, to think ahead in the way that you have, and sort of to show. I mean, this is what Dare spoke about. He in the panel earlier, he envisaged a situation where your WhatsApp was as closely linked to you as your home nation's wallet. And if you had a shared wallet with your mates or with your family, then when you went overseas, you still kept using that wallet. And this is probably some way away when we're talking about CBDCs. The barriers to that arrangement happening quickly are manifold. There's policy interoperability, there's technology interoperability. The INARA has been built on a chosen technology. If in France or Kenya it was built on a different technology, there's that different form of policy interoperability as well as technology interoperability. So there are a number of different things that prevent that from happening quickly. What I think is often interesting to focus on is where this sort of arrangement is already working. And so some of the work that we've done at SODA has been with NGOs, where they have sent cash benefits overseas to countries in Africa, Asia, and Latin America. And in those countries, instead of receiving cash benefits once a week or every day, they have instead received a stable coin on an NFC card or a stable coin on an app. And this is then spent as if it's the local currency with local nominated merchants within a pre-existing aid scheme. And there you can see that the donor in America can send a stablecoin donation and see the end user using it, and the charity, the NGO, have very good flow information. They can see how much money is spent, how quickly, how much is saved, what it is spent on, and then the merchants they can see how long it takes for the merchants to cash out. And so when you have those cross-border arrangements that are already working in quite narrow sort of aid cash deployment scenarios, the most interesting thing to do there is to try and repurpose those for private remittances. So if a recipient of aid cash payments can then receive money from their friends and family onto that NFC card, then you already have a situation where someone with a particular, say, US dollar stablecoin wallet can already send money to the person who has the NFC card or who has the wallet that can receive those tokens. And if the central bank simply say, this is the local currency, then it is. That is a CBDC, because they have minted one or they have created one. Now, this is only in pilot form, but the work we're doing at the moment is something which is gathering more and more interest with central banks in Africa in particular. And remittances is always the favorite use case for central banks. Why is remittances the favorite use case? Because they can see the remittance flows. Central banks would absolutely love that. They can also, if it's in a certain type of token form, see how and where the money is spent. Very useful for policy making. See how much money is spent on staples, how much is spent on education. You can also then see, you can protect the country from dollarization. You don't have to import cash dollars because you can see the money coming in at that. And the velocity of money, the actual economic impact, is quite far-reaching. One of the things about the delay and the cost is that remittances are not spent immediately. This can overcome some of that. So even though these are only pilots, and it's a different question when it comes to scalability, or what you're describing, which is a mass interoperable system of multi-token wallets, that we're not close to. So my sort of approach to this is focus on the use cases, get central banks interested in seeing the before and after experience for the sender and for the economy itself and for the central bank itself. And then from there we can say, well, okay, what technology can actually achieve this? And part of that is going to be making sure that the interoperable world that you were describing is easy to achieve.
Thank you so much. Richard, I know that the Central Bank of Nigeria is actually a leader in this field, and specifically you are looking for a solution as well for the remittances. Can you explain to us your experience on this in this field, on CBDC, of course? Yeah.
Okay, yeah. So one of the objectives of deploying the e-Naira is to increase cross-border remittances. And then we had proposed different options. In addition to the two you mentioned, currently Nigeria has a bilateral currency agreement with China. And incidentally, the Chinese government wants to deploy the EU1. So we're already in talks to see how we can cross the two currencies, that's the e-Naira versus the EU1. At the moment, what's happening is we are proposing, which is going to be deployed next week, an option of payment in e-Naira for beneficiaries of diaspora remittances. So the situation is that international money transfer operators would have to open a merchant account with the Central Bank of Nigeria and then pre-fund or post-fund with the foreign currency, in this case US dollar. So the US dollar comes, it's ensured that it comes, and then the wallet is credited with the equivalent of the US dollar sent. So now the question is, what exchange rate are we going to use? Because everybody knows here that there's a huge margin, the disparity in rates from the official and the parallel market. So the good news, and breaking to that there's a unification of the rates. Just a breaking news, just happened like 2 hours ago in Nigeria now. So we just have one rate. There's no official, there's no parallel. Meaning we're going to achieve the deployment of the e-Naira easily. So we have a rate which is just one rate. So wallets will be created, merchant wallet for the operators, and then funding into their accounts is strictly going to be from the CBN. No, the merchants will not be able to have that wallet credited from any other source. That is a way of monitoring. And so the operators will be responsible for making the transfers to beneficiaries. And now that will enhance cross-border remittances. Thank you.
That's great news. So we have some exclusive news here on the panel. Yeah, that's interesting. Barry, looking again to the CBDC, cross-border CBDC arrangements, one of the major obstacles that everyone was talking about when it comes to remittances is the long chain of intermediaries, of correspondence banks. Would the CBDC have a solution for this? Other issues, for example, related to the fees of the transfer, other issues related to the possibly exchange rate, as Richard mentioned here. How can cross-border CBDC resolve some of those issues?
Yes, so it definitely can is the short answer, but the devil's in the detail. So particularly what you really need to look at is, you know, the way that currency, because it's fiat currency. It's fiat currency from a foreign jurisdiction ending up in your country. So that really does a bit of it has a big implications in terms of like balance of payments and other. Can your citizens retain that foreign currency? What does that do to your monetary policy, your fiscal policy? It can make a nonsense of it. So, or it can subvert your economy to a much much more powerful. So those are all the things that need to go into the mix, because you are dealing with, in that value chain, 3 different kinds of currencies now. You're going to have foreign fiat currency, sovereign currency coming through, you've got commercial currency, and you've got physical currency. All 3 have got different risks, different logistics, and they should be priced differently, but they're all at the same unit of account. So it's a very difficult thing to get around. You need to make sure that the regulation is in place, because in the digital world, you can only really claim your sovereignty or your national jurisdiction where you can control it. Otherwise, digital is digital everywhere, and that's a problem. So you have to be able to contain or control the interaction with people in the digital world in your jurisdictions. So what it is moving towards is ultimately probably limited potency of jurisdictions, but in the short term, this becomes quite a difficult problem to deal with. Can it work? Yes, it can work. You also need exchanges, but the big problem is that the existing infrastructure, yes, it was based on trade, and it's probably 100 years legacy, but it exists, and a lot of people rely on it. How are you going to phase that out if you've got a new system that short circuits the inefficiencies without the unintended consequences of whole systems collapsing is another issue. So yes, the short answer is this can work really, really well. It can take out a lot of efficiencies, but it's not as simple as the highlight would lead you to believe.
Very true. Alan, maybe one of the model that they are talking about is that if, for example, we have Central Bank of Nigeria is issuing CBDC, why not Central Bank of Nigeria allow, for example, a bank in the US or in France to have access to the e-Naira, and based on this commercial bank that is actually based in France would receive possibly some euros in France from the remittance providers, or from the remitters, and then transfer it on, the bank itself, to the end user in Nigeria, in Nigeria here, who has a CBDC account. So instead of having arrangements between central banks, we can allow, or one of the models that are under discussion is that to allow a specific or a commercial bank to have access to the CBDC in a specific country, and based on this foreign commercial bank could act as a bridge between the one country and the other.
So really that question should be directed to Richard, honestly, because
Okay.
it is a policy and regulation decision.
Yeah.
Technically, an intermediary bank in Nigeria, central banks, they generally don't distribute digital cash directly. They go through intermediary banks. And so nothing could prevent, technically, a Nigerian bank to be an intermediary of the digital euro, for example. Why not? And so they would have to have an agreement probably with the European Central Bank, but yes, why not? And then they would have access to digital euros in Nigeria. And perhaps even further, people could pay with digital euros in Nigeria, if we come to that. But I'm not sure this would please the Central Bank of Nigeria. And so you get into policies and regulations that will probably prevent that from happening, or allow it. I don't know. Not my call, really. Yeah. Richard.
Richard, do you have an answer here?
Yes. I loved how Alan concluded it. It's going to be at a disadvantage to the Central Bank of Nigeria. Why? Because we are, unfortunately, an import-dependent country. So we want all the dollar that we can get, all the foreign currency that can get, and preventing the foreign currency coming, it's a disadvantage to us. So we wouldn't support that.
Okay. So back to you, Alan. There are realities on the ground whether you have a CBDC or a normal foreign currency exchange or remittance sending. So realities on the ground include the how strong are the domestic networks, what are the exchange rates. So those things actually impact the remittances in whether they are happening through CBDC or other systems. Do you think that CBDC could tackle any of those issues, or those would still be obstacles in the implementation of CBDC?
So I think if CBDCs are in place, it can simplify things probably greatly. The obstacles are putting CBDCs in place. It's a tremendous effort. I mean, I'm sure Richard can talk to that. It's a tremendous effort to deploy a CBDC nationwide. You probably have to change the law for a start, and then you have got to deploy all the technology and so on. And you've got to get adoption. You've got to get adoption. It's not an obvious one. And now, it depends on the country, I guess. In countries where you have very strong, established electronic ways of paying, whether it's with cards or credit transfers or, it's going to be hard for a CBDC to find its place, and we should not hide ourselves from that. It's not an obvious one. Okay. CBDCs have to have a compelling value proposition for users. Otherwise, why should they use it? Okay. And so, see, there are a lot of obstacles just to put CBDCs in place, okay, I believe, which is why they're not going to take off for a long time. I mean, there may be exceptions like Nigeria, but, but then, probably once they are in place, it will facilitate the implementation of remittances, not create additional obstacles. I don't believe so.
Okay, coming to Chris, and actually from the point that Alan raised about the value proposition, what could be the value proposition of CBDC in remittances?
Yeah, and everything that Alan and that Barry said there is very much correct. I mean, it's sometimes important, and I know, Ahmed, you've been very good at painting the future picture, but it's sometimes important not to start considering everything, because literally every policy area crashes into CBDC, because you've got the role of the dollar, you've got monetary sovereignty, you've got privacy, you've got anonymity, you've got identity, you've got cybersecurity, you've got geopolitics, you've just got every single thing here. So for me, remittances offers one of the best promises for CBDC. Not for a full CBDC rollout, that's to come later, but for central banks who can see and who did see that the Facebook Libra method could have worked and could have actually rendered national currencies in some emerging market countries redundant, then it is worth really looking at remittances. And please do come and speak to me afterwards, because I can't talk publicly about all the work that we're doing with central banks and remittances, but I can talk privately one-to-one. And so if you are in a situation where you already have some sort of system, either on an online or offline system, where people can cash out easily, where there's vendor acceptance already in place in the ground in your country, it's not actually a big step to say, let's open this corridor for remittances. This can be done safely, it can be done with few people to start with, but the key is the end users will be receiving their money immediately. They will have cash security. They will be able to spend it at their local vendors. The people who are sending the remittances will be sending it for way less than 1%. Forget this, 6%, 8%, 10%. They'll be sending the money for way less than 1%, and that can happen now. Now, this is not something that you can turn on for a whole country, but you can see what the promise of this is, because it is really far-reaching, and you've got to start somewhere to get to this sort of land of future promise that Barry and Alan and Richard have been describing. So I'm very much in favour of starting with remittances in these places, so that you can really make a difference here. So please come and talk to me afterwards, and I can share a bit more about that. But in terms of the cost, the data, the ability to change the lives of the remittance senders and recipients, I don't think there's anything else out there that can have such an impact where it's tried as this form of token-based public money. It could be sending in stable coins, receiving in CBDCs. It could be, but the central bank has to be involved for it to happen.
Okay. Barry, you have something to add here.
Yeah, just in our research, we survey and we also speak to many central banks. I think there's 17 in Africa alone that are running with programs. But they all say that financial inclusion is one of the big pieces, but cross-border is what they intend. But more recently, what's coming to light is that a full rollout of CBDC entails creating a whole new ecosystem within the country to spend the money to have any kind of a utility out of the value that you're transmitting. And so there's now a large portion of central banks that are looking to use the interoperability aspects of it in country, and then potentially managing the hops across to other jurisdictions. And the interoperability aspects are probably the biggest and more closer goals of CBDC. So, for instance, just the general CBDC, I'm not talking about wholesale CBDC, talking just a general CBDC with a sufficient wallet class structure can enable payment service providers to interoperate seamlessly with each other outside of any kind of oversight, because they're dealing in fiat, they're dealing in sovereign currency, and they're dealing in their own money. So you don't have a lot of the risks associated with commercial currency. And so that kind of interoperability can really set a value chain on fire. That can enable choice. It can enable geographical distribution. Those are some of the key pieces, and I think that's the low-hanging fruit that a lot of them are after. I think that's the thinner end of the wedge, ultimately, to broader CBDC ecosystems.
Yeah, I think what Alan's saying, the actual things you can do with your remittance money as a recipient is really exciting here. I mean, micro insurance for the first time, credit ratings for the first time, micro payments, the ability to borrow and lend money in a completely the type of habitat that's just not there. That's really the promise. It's just remittances offers one of the best channels to get there. And so that's the stage we're at now. And so I think it's important to keep the kind of prize of financial inclusion, which this will not solve all the problems for, but will do a lot for, in mind as we look at how remittances can help us get there.
Okay, thank you, Chris. Richard, maybe this is one question for all of you, if whoever wants to add to it. How can we make the best, the use of the potential of CBDC in remittances? How can we materialize this potential in the coming future, from central bank's perspective, from international organizations and others? Yeah, Richard, maybe you start. Yeah.
Yes. So it's a very big potential, the central bank digital currency, if there's adoption, if there is cross-referencing. So while the e-Naira has been deployed, we gave it a theme, same Naira, more possibilities. So it's a very big, open option. There are so many things that can be done with it. So we are inviting people. I said Sandbox has been open for different use cases. So whatever use case is available, we're open to it. Yeah.
Okay, great. Alan?
I would say a key word is ubiquitous use. In other words, the recipient of a CBDC's, the recipient of a CBDC-based remittance should be able to use it anywhere and everywhere at all times. And that may call for a variety of devices, not necessarily phones, and certainly not necessarily smartphones, because not everybody has them. So that's our view. I mean, we believe that it makes sense to have specialized devices that store digital cash that people can trust and that people can use easily at any point in time, even if there is no connectivity. So that's the ubiquitous aspect, which for us is key in adoption.
Chris?
And for me, it's the use cases. There has to be a before and after experience. Anyone who's got a CBDC or anything similar to public digital money in their hand that's like a CBDC must see how different it is from cash, how different it is from commercial bank money, and how that improves their life chances and opportunities. So a use case that shows a before and after impact is absolutely key here. So yeah, I think anyone who stayed to the end now gets 2 drinks, I think, at the reception afterwards, because we've got through all the blockchain and everything to get here. Thank you.
Barry, thank you.
So in the CBDC diagnostics we've done, we've seen that really what needs to happen is it's an economic circulatory system. If you don't have that in place, then at least the initial way is to do the business-to-business pieces so that you wouldn't even know that you're dealing with CBDC. It just happens in the background. All of a sudden, your options become a lot better. You can interact between your e-money and other accounts. It just happens. And that kind of thing, I think, is the initial steps. And later on, the ecosystems. What you don't want to do is almost like wholesale replace everything that's there with a whole new system, because these are different kinds of money. So it's about putting in the background and making sure that things work efficiently, and then looking to do the harder things, like particularly the cross-border or forex hubs or electronic hubs and those kinds of things.
Okay. I'll need to wrap up the session. So just back to the basic concept that we mentioned. Blockchain is just a database. You store data in it. From blockchain came the first cryptocurrency or crypto asset. That was Bitcoin. Bitcoin came from nowhere, but it has value, and you can exchange the value between different users, one from China, the other from the US, the third in Russia. In order to mitigate the risk of the volatility of the prices of Bitcoin and the unregulated environment of the Bitcoin, other institutions brought the concept of stable coins. Stable coins are issued by somehow regulated institutions, and they have a mechanism to mitigate the volatility in the price. By the way, stable coins, I cannot say it's 100% stable. It has a level of volatility as well. Then the central banks came in the game and started to say that, okay, why not we issue our own digital currency? Then it is, what is the difference between digital currency and the commercial bank money that you have in your, the card or bank account or mobile banking system? This is a direct liability on the central bank. This is issued directly by the central bank. Then one of the major use cases of this CBDC or the central bank digital currency is remittances. How they can do it, there should be a sort of an arrangement between two central banks, or maybe a regional arrangement among a number of central banks, where they can exchange the value of CBDC among their citizens directly. The major promise that CBDC is bringing here to remittances is that it avoids the long chains of correspondent banking, because you don't have correspondent banking here. It's just from central bank money to central bank money. You don't have, the system would be open 24/7, so you don't have issues related to the delay of sending the transaction or waiting for one day or another. The fees may be minimal because those are arrangements between central banks. However, there would be a sort of maybe a commercial bank that is either taking the money from here or there. But at the end, CBDC would not resolve all the problems. Other problems exist. You need channels to distribute the CBDC. You need channels to redeem the CBDC. If I receive the CBDC, I want to transfer it into cash, for example, I need a channel to redeem the CBDC. There might be still problems related to the prices, black market prices for the exchange. In the central bank exchange, I think most of the central banks would not do. Actually, what Nigeria did is a very brave action, but most of the central banks would just exchange on the formal price, not the market price. So we still have a lot of issues associated with the CBDC, but it would actually help solving some of the issues. I think this is the most session that the moderator spoke in, so I would be silent now, and you will. Thank you so much for the panelists. I think it was a great session. Thank you so much.
Just a photo. Dear colleagues, now we're going to have a shorter coffee break. While we take a photo, so the coffee break is over there. we'll ask you if we can make it on 20 minutes. You will hear the bell before we, and we'll shut off the coffee. But then we need to go for the last session of the day, the sum up, I think, in terms of innovative approach to this in relation to remittance, migrant contributions, and climate adaptation. So I will ask you kindly for the coffee area, and we will be calling back to gather in this plenary in 20 minutes.